Welcome to TheoTrade. This is Don Kaufman. It's January 26, 2019, and you are watching the TheoTrade Weekend Update. Well, we're going to begin with a little discussion on the S&P 500, which on the week was massively unchanged. So it was a holiday week of trade. We had 4 trading days. The week kicked off with some really intense volatility in the broader markets on Tuesday, some big sell-side activity. But for the most part, what did we do? Thursday, Friday, we kind of clawed back most of those losses earlier in the week. And again, the week as a whole, where did we finish? Completely and totally unchanged. Literally kind of, week over week, we lost about 5 points inside of the S&P 500. However, the Nasdaq also unchanged in the Dow. The Dow finished the week slightly higher. Again, week over week, slightly higher inside of the Dow. That was specific to a couple of earnings announcements. Well, let's really get kind of down to it. In this video, what I want to do is, well, first of all, we're going to do some very in-depth discussion on some trades and some trade ideas moving forward. I think that that's absolutely, imperative at this point in time is where are you going to go with your trades? And more appropriately, here are some trades for you moving forward. In fact, in just a moment, I'm going to get into that. I'm going to spend a lot more time here in the options chains than I am necessarily in the charts. On other kind of area that I want to focus on is some of the news this week. I got to tell you, some of the news this week was absolutely downright pessimistic. Whether you were looking at Davos, for those of you that did tune into, again, the economic forum in Davos, it was pessimistic. I mean, that was the final thought, what was Davos 2019? And it was just, pessimism at its best. Maybe a little bit overdone in terms of pessimistic. But again, these are CEOs, these are hedge fund managers, the heads of state, all gathering in one lump sum to come out with one idea, and that is 2019 has got a lot of pessimism to it. The week also kind of began with the IMF, and the IMF, for those of you that don't know this, they downgraded global growth, and again, it's the second time they've actually downgraded 2019 global growth. Nothing new over there, although again, that kind of sparked some of the volatility earlier this week. One of the things I think that surprised me personally is all the negative news that was out late in the week. Again, this is before, the government shutdown kind of ended, but there was all kinds of pessimism late in the week. Where do you want to start? You want to start with like Intel's bad earnings. Okay. Again, the pessimism out of Davos. I can go on and on. The government shutdown was still going on, and yet the marketplace still was capable of staging a rally and ending again largely unchanged on the entire week. So with that, and we're going to look at some of the bad Intel earnings over here. Call it what you will, but listen, do you have technology sector, which is an absolute monstrosity, and one of the key components in technology sector, which happens to be none other than Intel, they missed, and they missed a lot of different areas. Again, feel free to tune into some of the news on Intel yourself. Okay, is that going to be a little bit of a one-off? Because Intel, again, they have their hands in so many different technology businesses, and again, they're providing to other technology companies. It's a lot to think about coming into this next week, as we're going to see, the likes of Apple reporting early on in the week. Again, I think there's going to be a lot of pent-up aggression and volatility around some of the tech earnings over there. Again, bad news from Intel, though, it didn't do anything to the marketplace. The S&P still rallied, 31 handles coming into Friday. So again, push aside some of the negative earnings and move forward. One of the things, before I get into some really specific trade ideas, and again, that's exactly what we're going to do here momentarily, one thing that I want to discuss for just a moment, and this really, this idea is kind of sparked from some of the pessimism maybe out of Davos or the IMF downgrading again, but in 20 years of my trading career, I can't really remember any other time where I heard CEOs, forget about my opinion for a second, but I can't remember another time where I've heard so many CEOs really display so much uncertainty, okay, in their projections moving forward. And that's really kind of the name of the game right now. There's no clarity whatsoever. I mean, some of these companies, their guidance is changing fairly continuously. In fact, there's a number of key companies, people are talking about, did they make their earnings? Well, yeah, they hit their numbers, right? Their earnings per share, they hit it right on. The only problem is they downgraded themselves multiple times, and they warned lower, multiple times prior to doing that. But again, the big theme and the idea I want to give you here as we go into some of the trades is we have very little clarity right now as to, forget about even a week from now, a month from now, 3 months from now, okay? I think that the bottom line of that is growth, global growth specifically, is absolutely slowing down. Okay, so where's the uncertainty, right? Hey, these companies are, all right, we're slowing down, we get it, we're gonna, pull in the reins a little bit. I think that the uncertainty, okay, is being driven by the fact of what are central bankers going to do? China is already giving you their answer. China's out there with a fire hose just spraying liquidity into the marketplace, okay, like there's no tomorrow, which as a trader makes me nervous, okay? Because, when China's spraying liquidity like that, they see major headwinds. That is, again, my interpretation, my opinion, that China sees massive headwinds right now in global growth, okay? It's really, though, that clarity issue is here in the US. We're not sure what the Fed is going to do. Are they going to continue quantitative tightening? Okay, the idea of raising interest rates right now, I think it's completely off the table. But if that quantitative tightening continues, it's still going to constrain growth over here. I think that the larger takeaway from that, as I said, the bottom line, of none of this clarity has a lot to do with the Fed. Again, we know things are slowing down. Can the Fed actually re-kickstart it? By the way, is that a good idea? We have $4 trillion on the balance sheet. Let's just open up the fire hose again. Let's make it $6 trillion. Let's just go for a new record. But I think the bottom line of all of that, we're going to be in a highly volatile situation. And that doesn't necessarily mean sell-side activity. We're going to be a highly volatile situation. Markets are going to feel this instability, this uncertainty moving forward. With that, let's get to a couple of charts. But more importantly, let's go in depth in some option chains, show you a couple of trades. All right, to charts and trades we go. Let us start here in the SPX. Just a quick, brief, and dirty explanation of the expected move. In fact, I'm going to zoom in on this to give you just a better, cleaner, tighter view of what we kind of anticipate movement to be moving forward. One of the first things that I want to kind of elaborate upon just for a moment happens to be the expected move effectively from last week. So this expected move again from last week, and this is again, it's just a week over week, right? So we had a holiday trading week, which is 1, 2, 3, 4 trading days. This is just over a $40 move being anticipated. What effectively happened on Tuesday, negative news, IMF comes out, we drop down. What do? We kind of ride the edge of this expected move throughout the course of the week, only to rally back up. As I said, on the week, this is where the week began. This is where the week effectively ended. What do we see? Massively unchanged. Now, what are we expecting moving forward? Well, moving forward, the expected move, it's expanded out, okay, minimally speaking. Again, this is the beginning of our week. The beginning of the week is the end of the previous week, so we're all clear about that. And right now, we've just around a $47 move. So we're expecting this $47 move higher, okay, or $47 move lower. One of the first things that I would tell you is that on a weekly basis, I would not go out. Again, and I've been reiterating this week in and week out, I would not go out and try to sell weekly options and think that you're getting away with something because, well, if you did that, and I'll give you a perfect example. If you did that last week, look right there. Okay, I mean, we were way outside the expected move early last week, and in which case, if you had sold options, well, you would have had to have felt the fear to quite some degree. But with this $47 move, again, I caution you, the volatility in the marketplace right now is acting like a fly. It has absolutely no memory whatsoever, and the volatility is just expanding and contracting, okay, with every ebb and flow of the marketplace. Quite frankly, in the in the SPX, I do not believe that the volatility is doing a great job of kind of handicapping some of the risk. Again, on a week-to-week basis, I am just right at this point in time. I'm not willing to be selling premium in the short duration. And I want to make that just abundantly clear. Now, as I was showing you again a moment ago, about a $47 expected move. Where do I derive that from? Just go out to the Friday options, and there you go. There's effectively the expected move that we're using on the chart. With that being said, let us then go into some really specific trades. One of the first things, as I was saying, a lot of earnings are coming out, uncertainty again being kind of the name of the game. As I said, also the CEOs, if you've listened to a couple of the conference calls, whether it was the banks, okay, or again, some of the technology companies that have already reported, the lack of clarity was alarming, I think, to say the least. And as such, one of the first trades I'm going to bring to your attention happens to be inside of the VIX. Now, the VIX is again, the volatility index. It's just the S&P 500 volatility index. Why even consider a trade in the VIX? Well, a moment ago, I was telling you, hey, listen, volatility has right now almost like no memory whatsoever. Okay, where it's literally kind of ebb, flow, up and down, just as the markets are. And I think that we could take advantage, at least at this point in time, of, I wouldn't necessarily call this a floor in volatility, okay? But right in and around the 16 level in terms of the VIX has been effectively its low going back into, again, the beginning of October, when most of this volatility had been kind of sparked. So with that, what type of a trade we can do if we believe that the VIX is going to be over 16? And the answer kind of comes in what I term a VIX volatility spread, or a VVS spread. I'm going to actually go 51 days out in time to really make this trade more effective, okay, for not just the near duration, okay, but to give us a bit, again, of a volatility kind of hedge going a little further out is effective in this case, giving us enough premium also to be able to work with. Effectively, what this VIX volatility spread breaks down to, and you can see I've already got positions on here, we're selling the 16s, okay, and buying the 1250s. Now, this is the sale of a put spread. This put spread is the sale of that put spread's for about 65-cent credit. And what I'm doing with the capital that I'm collecting is I'm going out, then I'm purchasing a call spread. Okay, it's, people can look at this. It's like a synthetic combo. There's a lot of different ways to effectively look at this particular trade. But here's what the VIX volatility spread breaks down to. And that is, again, I am buying a $5 wide call spread, and I'm financing that, okay, with actually selling again a $3.50 wide put spread. Now, does this trade have risk? Yes, but the trade is being put on for right around a 5-cent credit. And we can take this one and we can right click on it and drop it over. We can analyze the trade. This is what, this is what our VIX volatility spread will effectively look like, just depending upon where the VIX, ultimately falls. Anyway, anywhere right in this neighborhood from 16, okay, up to about the level of 22, we don't really make anything. I mean, we get to keep like our 5-cent credit. Above 22, we start to see a degree of profitability. However, is there some risk? Yeah, if the marketplace explodes to the upside and volatility just collapses, okay, we could have as much as $3.50 of risk. Although that $3.50 of risk, there's the possibility, of course, of rolling that put spread further out in time and trying to mitigate a degree of that risk. However, the theme I've given you already, okay, in this video is uncertainty, and that uncertainty, I believe, is going to keep, okay, the VIX higher to some degree. I mean, could the VIX come back down to the 14 level? Sure, in the midst of like a really, again, an additional kind of wicked rally, but I'm going to discuss that here momentarily. So the idea of the VIX, though, falling all the way back to the 12 kind of region, I think is that's a hard one to swallow unless maybe the Fed completely changed their tune it would have to be in the next couple of weeks in this circumstance. And speaking of the Fed, they're coming. All right, coming to a theater near you. Yeah, there's going to be all kinds of Fed speak again as this week progresses. With the VIX trade, again, that's a VIX volatility spread. Again, we're selling the 16s to buy the 1250 puts to turn around then and purchase a 22.27 call spread, all done for about a 5-cent credit out in the March expiration. acceleration. That's a VIX volatility spread. Another trade that I've actually created is right here in the spiders. And as I said, and with all this uncertainty, okay, let's just get down to kind of brass tacks. We want to know some trades and some trade opportunities that are right here, right now. Well, for this one, I'm going to cruise over to the Analyze tab, and I'm going to go through these trades kind of individually. All right. First of all, the trade that you're looking at right now on the risk graph for it. In fact, I think the most effective way to look at this isn't necessarily to look at the primary risk graph, but again, here's, I think, a more effective way to look at this. This one is an RTS spread. What is an RTS spread? It's a risk twist spread. What a risk twist spread happens to do is right there. That's where the market currently is. Okay. What the risk twist spread does is it, can make a boatload of capital if the markets are to tank. Now, this risk graph that you're seeing, and again, the acceleration to the upside, that risk graph is valid. However, if the market, I should say, were to go down, the volatility effectively goes up, and the volatility going up would actually pump, better premium into this trade. And instead of making, X amount, we'd make X plus. So you can kind of play around with the volatility a little bit to get a better feel for this trade. In fact, I can take volatility and I'll give you an example. I'll pump it up like 10 full points. Okay, and you can see the expansion of this trade in a big way. Now, again, this is what we term a risk twist spread. Let me go in here now and just reset some of my parameters. It's a risk twist spread. Why consider it? I don't know, uncertainty between now and the April expiration. Now, for those of you that know a little bit about the risk twist spread, the April expiration, it's not that far out in time. It's only it's 82 days out. Okay, and understanding this risk twist spread, you have got to understand, again, in context of I am selling the 260 puts, I am buying 3 of the 250 puts, and then I'm selling 1 of the 248 puts. Why do I use such a ratio? The reason it's called a risk twist is to offset and counter some of the skew, that we have to deal with inside of a product like the S&P 500, or in this case, specifically the spiders, which is the ETF version of the S&P 500. So the risk twist spread, is designed to counter, again, some of the skew. It's twisting the skew back in your favor. That trade is going for about $1.69 debit right now. But what does it do? It gives us, a trade that if the marketplace tanks in the next 50 to 60 days. Now, I know that the trade is out 82 days out, but you can't hold this trade for 82 days. You do have to bail it, well before the expiration. However, if the market tanks in the next, again, we'll call it 40, 50, 60 days, you've got yourself a lottery ticket, to the downside for $1.69. Now, on the other side of the coin, we actually put on a very simplistic back ratio spread. That's it. It's just a back ratio spread. What am I doing? I'm selling 1, of the March 1st, 267 calls, and I'm buying 2, of the March 1st, 272 calls for a 5-cent credit. What does that give me? It gives me this upside shot. Now, this one can't go as far out in time. Can't go as far out in time as April. But if we get, again, this explosive move to the upside, I mean, what am I effectively doing? Well, why play one side of the marketplace when you can actually play both? The only thing that leaves, something to be desired in this trade is, first of all, one of my trades is actually broken where? Into the March expiration. That's our upside shot. The downside shot, well, that's broken all the way out into the April expiration. That's okay. All right. And this is effectively what it looks like, what we call kind of day stepped out. So do we have any risk in here? Yes, of course we have risk. Like, you're never going to be able to put on positions that are going to be riskless. But the risk that kind of exists is in a fairly tight zone. What do we need to have happen? Well, we just need movement. We need movement. We need big movement. And we think that the uncertainty over here, in this marketplace can give us just that. As I said, if we kind of blow back through to the upside, hey, we've got a trade that's on for that. If we just, take right back off to some of the lows, which, again, my overall theme has been a very, very bearish one, and we can very well, again, perpetuate that down move again. We want you on both sides of that. Now, if we get trapped once again inside of the volatility box, that'll be okay as well. The upper end of the volatility box, which is right around the 280 marker, go take a look at that. Even at the 280 marker, again, I want to show you this very specifically. Even at the 280 level, which is right here, okay, we are seeing a degree of profitability. And again, because I am very, very realistic with this, if we get back inside of this this volatility box, the hurt locker, we want to be prepared for that. So what do we have when we put this trade on? Okay, we've got this area from probably around 260 to about 275-ish. That area right there would not be good. I mean, we would take some degree of losses in that particular kind of area. Anything outside of that, though, has, again, degrees of profitability. So this is using, again, a risk twist spread plus a back ratio to effectively do what? Well, to take both sides of the marketplace. So I'm giving you, again, a few different trades. One in the VIX. The VIX, let's be clear about that. Okay, in the VIX trade, this is a shot that if the marketplace tanks, the VIX explodes back to the upside, the VIX explodes back to the upside, you have your kind of lottery ticket, and again, it's $5 wide call spread. You'd see a really good degree of profitability on that. But at the same time, the VIX trade doesn't take any risk, okay, as long as we're above like that 16 level, and we're towards the lower end of the range. We don't feel that we can time anything in this kind of uncertainty, okay, but this is the proper trade to put on at a time like this at the lower end of the range. On the other side of the coin, we're kind of taking both sides of the marketplace inside of the spiders. Again, given all of the uncertainty around this, we have the Fed that's coming out in the very near term, earnings from some of the largest companies. Listen, this is going to be some fairly tumultuous weeks of trade. I think you have to kind of redefine what you think volatility is. We've seen volatility in just the last few weeks to the downside. We've seen a vicious move back to the upside. Again, my longer duration stance absolutely still remains bearish. I want to make no unequivocation about that. But being realistic at this point in time, we could still burst back to the upside. If anybody starts to beat earnings over there, okay, we start getting along with China. There's a lot of problems that could get solved maybe in the near term. Long duration, though, still going through a global slowdown. With that, I want to thank everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.